Hey everyone, welcome to video number 2 of the charitable giving video series. In this video, we're going to continue where we left off in video 1 by doing a comprehensive example of charitable bunching. Now, even if you don't do that much charitable giving, understanding the charitable bunching strategy can help you understand many other tax planning strategies, because the bunching strategy is a timing play, and so are many other strategies. Timing in tax can be very important. So let's hop in and do some charitable bunching. Alright, in scenario 1, let's assume we have $12,000 of mortgage interest and $8,000 of state and local taxes and $0 for the moment in charitable donations, resulting in a total of $20,000 of itemized deductions. Therefore, in scenario number 1, assuming married filing joint, we will be taking the standard deduction, which is $29,200 for 2024. And also note that for all of the examples that we're about to go through, let's hold the standard deduction constant at $29,200 over a 10-year period, so we can focus on the concept of charitable bunching and make the math easy. So in scenario number 1 with the standard deduction, we're going to assume an adjusted gross income AGI of $150,000 annually over a 10-year period, and we're going to assume the standard deduction, as we just said, of $29,200 over the same 10-year period, resulting in taxable income of $120,800 for each of the 10 years. But the key number that I want you to take away from this example is going to be this starting point right here, $292,000 of standard deduction over a 10-year period. Okay, now in scenario number 2, let's assume the same fact pattern as scenario number 1, except that we begin making $10,000 of charitable donations annually. Let's also assume that we do all of our charitable giving on December 31st of each year. So now we have, for this example, $20,000 of mortgage interest and state and local taxes, which is the same as scenario 1, and we have $10,000 of charitable contributions, resulting in a grand total of $20,000 plus $10,000 equals $30,000 in itemized deductions. So in scenario number 2, we begin itemizing deductions instead of taking the standard deduction. And here is scenario number 2 laid out right here, itemized deductions without any charitable bunching. We have the same adjusted gross income of $150,000 annually for the 10-year period. This time we're going to do itemized deductions of $30,000 annually, resulting in taxable income of $120,000 annually. And the key number to take away from scenario number 2 is $300,000 of itemized deductions over the 10-year period. So what benefit did we get each year by itemizing deductions? Well, we got an $800 benefit each year. In other words, $30,000 itemized minus $29,200 standard deduction. So we went out of pocket $10,000 in charitable giving each year and received an $800 deduction for it. Now here's a check just to make sure we did the math right. We have an $800 benefit for 10 years is $8,000 total benefit. We can also double check that the same way by saying $300,000 of total deductions in scenario 2. Here's the $300,000 right here, minus $292,000 of total deductions in scenario 1 equals $8,000. And here was the $292,000 of deductions over the 10-year period in scenario 1 right here. So the grand total is that $10,000 of annual contributions times 10 years is $100,000 of charitable giving, which got us only $8,000 in tax benefits over that time period. All right, now in scenario 3, assume the same fact pattern as in scenario 2, except we do our charitable giving according to the following schedule. So in 2024, we do no charitable giving. Then on January 1st, 2025, we do $10,000 in charitable giving, and we indicate to the charities that, hey, this is really for 2024. In other words, this is my donation for 2024, even though we made the contribution, quote unquote, one day late. Now note that when I say really for 2024, that's not from a tax perspective. From a tax perspective, the year you give the donation is the year it's going to count for tax purposes. What we're talking about here is that your indication that, hey, this is really for 2024, that's from like a practical fiscal perspective for the charity itself, which is not a taxable entity anyway. In other words, does it really matter to them, the charity, from like a monthly or annual budgeting perspective if they got the money one day late? So we're going to go with the assumption that a 1 day difference doesn't matter to them for purposes of their fiscal planning. Another way to look at it is you're the one doing the charitable giving anyway, so you have the discretion to give whenever you want. They just have to deal with whenever the money arrives. But from a practical perspective, a lot of people who do giving on a regular basis, they like at church, for example, they will make some kind of like annual commitment, like I'm going to donate a certain amount over the course of this year. And so when you make that commitment, people want to meet the commitment that they made. And so what we're saying here is, hey, yeah, I met the commitment. This is really for last year, the commitment that I made. I just happen to have given it to you 1 day late. And from the charity's perspective, which isn't a taxable entity, so it doesn't matter from a tax perspective which year they got it in. Does it matter really from their budgeting perspective that it arrived 1 day late? That's the argument that we're making right here. All right, so quick recap. On January 1, 2025, we did $10,000 in charitable contributions, and now on December 31st, 2025, we're going to do another $10,000 in charitable giving, and we indicate to the charities that this one is for 2025. So far, you can see that we have done two now in the same tax year, January 1, December 31, effectively they're a year apart, but technically they're in the same tax year, 2025. Okay, then in 2026, we do no charitable giving, and then the cycle repeats. So on January 1st, 2027, we do $10,000 in charitable giving, and then on December 31st, 2027, we do another $10,000 in charitable giving. We basically indicate, hey, this is the one that's actually for our 2026 commitment, and here's the one that's for our 2027 commitment, and they are effectively a year apart from the perspective of the charity, but from our perspective, they occurred in the same tax year, 2027. So just to summarize now, from the perspective of the charitable organizations, did they effectively receive a $10,000 donation from us on an annual basis? And the answer, I would argue, is effectively yes. These are basically 1 year apart right here. I mean, it's true that they both occurred in 2027, but effectively they are 1 year apart. So the charity did receive effectively $10,000 in donations on an annual basis. And then from the perspective of our own cash flow or our own giving needs, did we effectively spread the $10,000 donations out into 1 year intervals? And again, we did. This is effectively a 1 year interval right here, even though technically both occurred in the same tax year. Okay, so what did we accomplish from a tax perspective? Well, we bunched 2 years of charitable giving into a single year, and we did it multiple times as follows. We did our 2024 giving on the first day of 2025, and then we did our 2025 giving on the last day of 2025, so we bunched 2024 and 2025 giving into the same tax year, 2025. Then we did the exact same thing again here. We did our 2026 giving on the first day of 2027, and we did our 2027 giving on the last day of 2027. So in bunching years, as we will call them, so 2025 is a bunching year, 2027 is a bunching year. In bunching years, we have $20,000 of mortgage interest and state and local taxes. That's the same as scenarios 1 and 2. 2. And now what's different is that we have 10,000 of charitable contributions plus another 10,000 of charitable contributions in the same tax year, in the bunching years, resulting in a grand total of 20,000 plus 20,000 is 40,000 in itemized deductions during the bunching years. So now let's go down here and let's just look at this first table for a moment. Scenario 3, itemized with charitable bunching. So the AGI is the same at 150 every year. Now what we do is we take the standard deduction in non-bunching years. So in 2024, 2026, 2028, and so on, we take the standard deduction. In the bunching years, we itemize. So we're taking $40,000 in 2025, we're taking $40,000 in 2027, and so on. This table down here is just a detailed breakout of what's going on in this. This is the same scenario number 3, except it might just be easier to see. Here's the standard deduction. In every other year, we're taking the standard deduction. And then again, every other year, right here, and right here, here's our items that exclude the charitable giving, and then here's our 2 years of charitable giving bunched up into 1 year. So now the number to take away is $346,000 of total itemized deductions. All right, so now let's compare the results. The scenario 2 results were as follows. We did $10,000 of annual giving for 10 years was $100,000 of total giving. And if you recall, we had total itemized deductions taken of $300,000. Let's go all the way back up here to scenario 2. Here is the $300,000 that we talked about right there. But now in scenario 3, the results are we did $20,000 of giving every other year times 5 years is $100,000 total giving. So the total giving between scenario 2 and scenario 3 is the same. It's still $100,000. But now in scenario 3, total itemized deductions taken $346,000. So by bunching our charitable giving into an every other year arrangement, every other year from a tax perspective, but again, basically one time annually from a fiscal perspective, from a budgeting perspective, yeah, it's 1 day late, but it's still almost every year. It's still on an annual basis, except for tax purposes, it's an every other year arrangement. And so by doing that, we received an extra $46,000 of tax benefit over 10 years. All right, now let's do a quick reconciliation of the $46,000 of extra tax deductions, just so we make sure we understand exactly where that's coming from. So number 1, by bunching 2 years worth of charitable giving into 1 year, we received the full benefit related to the extra $10,000 of giving every other year for 5 years, which is $50,000. Remember what we said earlier, that part of the original $10,000 is being used just to get up to and above the standard deduction threshold. So now when you layer on another $10,000 of charitable giving, that entire amount you get benefit for. So again, it's that extra $10,000 for 5 years is $50,000. And then number 2, on the flip side, we lost the $800 in annual benefit that we were getting in scenario 2, and we lost that every other year for 5 years. Remember, because we were taking $29,200 of standard deduction now every other year instead of the $30,000 in itemized from scenario 2, which is where that $800 annual benefit came from. It was the fact that $30,000 was larger than $29,200 by $800. So $800 times 5 years is $4,000 that we lost. Okay, so the net benefit received was the $50,000 of benefit that we gained plus the negative $4,000 of benefit that we lost, resulting in $46,000 of additional benefit. Now, for those of you following along in the Roth IRA conversion video series on YouTube, you can find that video series, by the way, by searching YouTube for Number Crunch Nerds Roth IRA IRA conversion. Let's go over how to incorporate the bunching strategy into the personal tax planning template. All right, so we're in the personal tax planning template. As you know, we have all of our ordinary income items here in the first section. Then down here we have our long-term capital gains and qualified dividend items. Then we have our Schedule 1 adjustments section down here. And now for this video, we're going to be working in this section right here on standard and itemized deductions. And I have set this up similar to what we just talked about in the examples. In fact, let me just highlight this section in yellow so we can specifically see what we're talking about. So if you recall from the examples, we started with $20,000 of mortgage interest as well as state and local taxes combined. So that's what we have right here in 2024. And then in 2025, we started layering on our $20,000 of charitable contributions. Now, something that I've done a little bit differently than the example here is I started layering on a growth rate into our state and local taxes because I would expect that our property taxes will increase a little bit each year over time. On the other hand, down here in mortgage interest, I've layered on a decreasing rate because I would expect that the amount of interest that we're actually paying on our mortgage debt will decrease over time, opposite to what's happening up here with property tax. But other than those increasing and decreasing rate adjustments right there, this is essentially the example that we just laid out, where in 2024 we had $20,000 of total itemized versus the standard deduction of $29,200. And so we went with the standard deduction. On the other hand, in 2025, we have $39,850 right now in itemized versus a projected standard deduction of $29,700 for 2025. We have to project it because the actual amount hasn't been announced yet for 2025, resulting in us taking the itemized deductions of the $39,850. All right, now that we've kind of set up the framework here of what a typical bunching strategy might look like, the next thing we want to do is start to think about how can we use the bunching strategy in conjunction with some of our other strategies. For example, if we scroll back up here to the top, how can we use it in conjunction potentially with doing Roth IRA conversions? So right now, for example, I have a $40,000 Roth conversion in 2025 in this fact pattern that we currently have laid out in the template. So right now, as things stand within the template for 2025, including a $40,000 Roth IRA conversion, we have $269,500 of ordinary income. Then we'll scroll down here. Right now, we don't have anything populated for capital gain. We don't have anything populated for Schedule 1 adjustments, but that can always be adjusted later based on our facts and circumstances. And we have $39,850 in itemized deductions. If I scroll all the way down here, that results in the following. So we're in the 24% marginal tax bracket right here. And then how much room do we have left in the bracket? Well, we go down here. The top of the bracket is $395,417. So we scroll up to right here, and we have $229,650 of ordinary taxable income after taking our itemized deductions. So there's a fair amount of room still in the 24% bracket. $229,650 is what we have, and we could go as high as $395,417 before this bracket gets filled up. So let's just say that we want a scenario test between doing Roth IRA conversions as well as doing an itemized charitable contribution bunching strategy. So let me go over here to the Roth Conversion Tax Strategy tab. This is where we figure out our tentative as well as our actual Roth IRA conversions, which we've covered extensively in the Roth IRA conversion video series. So let's just say that we're working through this, and based on our IRA account values and our projected growth rates and our future RMD projections and so forth, we decide, you know what, instead of a $40,000 Roth IRA conversion in 2025, I'm going to experiment with, let's just say, $225,000. I'm going to throw in a $225,000 Roth IRA conversion here and see what happens in the personal tax planning template. So I'm going to head back over to the personal tax planning template, and the first thing I want to look at is what is my taxable or ordinary income now. So we're at $414,650, and if I go down here, we can see that we have now exceeded the top of the 24% bracket. In other words, we have filled the 24% bracket right here, and we are now being taxed at the 32% marginal rate. Now let's say I don't like that. I don't want to be taxed in the 32% marginal rate. I only want to be taxed up to the 24% marginal rate. I'm happy being taxed there. I want to fill my bracket, but I don't want to be in here. I don't want any income taxed here. And it looks like with that Roth conversion that we just set up of the $225,000, I created too much taxable income. A Roth conversion will create taxable income, and I created too much and bumped myself into the 32% bracket. And so what are some options that we have to deal with this? Well, the first thing is we could go lower our Roth IRA conversion. Let's try that. I'm going to go back to the Roth conversion tax strategy tab. I'm going to go back to my 225, and I'm going to change that to 200 instead. Let's see what that does in the personal tax planning template. So I go back over here, I look at my taxable ordinary income, which is now $389,650. It's below the top of my bracket, and we can see that I have almost maxed out my 24% bracket, and I'm no longer being taxed in the 32% bracket, so that's one option. But let's say that I actually want to convert to 25 for other reasons. I've looked at my future RMDs, I've looked at my future income projections. I've looked at what brackets I might be in after I reach age 73, and I've decided I really do want to do 225 this year for whatever other reasons. So now let's go back to the personal tax planning template. So now we're back where we were here. What's another option we could look at to get ourselves out of the 32% bracket again without lowering the amount of Roth IRA conversion that we were doing? And the answer for what we're talking about in this video is we could look at our charitable bunching strategy. So let me make this screen bigger just so we can see everything in one place. Okay, so here's where we are currently at in the bunching strategy for 2025. We got our $20,000 there, and as you can see, we're still in the 32% bracket based on our Roth IRA conversion of the $225,000. So now what if I increase this to $30,000 instead? Okay, we're almost out of the 32% bracket. How about 35,000? Almost there. How about 40,000? And we're out. So at $40,000 of charitable contributions for 2025, we get ourselves out of the 32% bracket right here while still doing the Roth IRA conversion of $225,000 that we wanted. Now, what other adjustment do we need to make, if any, in this row right here for charitable contributions? Well, it's just going to depend on your situation. We could skip this year, for example. I could just put 0 there, and so we've moved the $20,000 that was here into here. Obviously, you'd have to have the cash available or the securities or whatever you're donating available in this year in order to accomplish this. On the other hand, maybe your giving strategy is such that you're actually good doing $40,000 here, and then you'll just bunch 20 every other year going forward after that. It's just going to depend on what you want and your ability to accomplish it. But the key takeaway is that by bunching contributions into the same year, we're able to accomplish other tax planning goals like larger Roth IRA conversions without bumping ourselves up into those higher brackets. All right, let's go over this charitable bunching summary. So charitable bunching is a great strategy to get increased tax benefits out of your charitable giving, but there is one practical problem for some people. And the practical problem is that people often like to do charitable giving on a regular and recurring basis. This is often particularly true when it comes to tithing, for example, at your church or other religious institution. For example, people like to give weekly or monthly or whatever the case may be. But in the bunching strategy, as we just went through, you're basically skipping years entirely in order to to bunch charitable donations on an every other year basis. And that's the practical problem. With the bunching strategy, you can only give on a weekly or monthly basis every other year. So just for example, let's say you were doing weekly tithing. Well, what you could do for a bunching strategy is every week you could tithe 2 weeks worth of giving. And you could do that for an entire year, so you've effectively tithed 2 years worth of contributions within a 1 year period. But then of course you'd still have to skip the entire next year. And for a lot of people, that doesn't work. For a lot of people, tithing is part of the act of worship, and so you can't just skip a whole year. And because of that issue, that is where the donor-advised fund or giving account comes into play, and that is where we will pick up in part 3 of this video series.